How do you define performance persistence in the context of private equity fund managers?
Performance persistence generally means that there is some link between the performance of one fund raised by a given fund manager and the subsequent funds that are managed by the same fund manager. It's something that has not been found generally in other asset classes, where for mutual funds or hedge funds, for instance, a winner this year, a fund manager that has winning performance this year, in the common years will probably revert down to the mean and only have average returns. So in most asset classes, it is not a winning strategy for investors to look at who's generating returns today to allocate funds tomorrow.
Is there a performance persistence in private equity?
Indeed, there is. Private equity has been found in the leading academic articles to be one of the few asset classes where there is performance persistence. So there is a statistical finding that those fund managers who are in the top quartile in a given fund generation are most likely to also be again in the top quartile in the coming fund generation.
Okay, so what is the main difference then between the method used to demonstrate performance persistence in academia versus performance persistence for LPs to make actually decisions on their fund selections?
Well, this is a very, very important topic because it's a little bit of frustration here. Often practitioners don't pay much attention to what academics say. In this case, they did, and private equity very much functions today based on this notion of performance persistence. However, there's indeed an important difference in how persistence was defined for the academic studies and compared to how limited partners actually have to make investment decisions. The academic study basically look from today back at very old and mature funds, and they try to understand whether the fund, say, raised in 1994 and the fund raised in 1997 from the same private equity fund manager have a similarity in their performance. And the answer there is clearly, yes, there is such a performance correlation, which makes then private equity from an academic standpoint very interesting because it is one of the few asset classes where there is statistical evidence for performance persistence. Interestingly, however, that academic setup is very different from the real-world challenges of limited partners because they do not have the luxury to wait until 2013 to observe the long-term performance of those funds. They need to usually make an investment decision when the prior fund of that fund manager is 3, 4, or 5 years old. We replicated the study of performance persistence, taking into consideration those real-world constraints for limited partners. So we didn't ask the question, is there a similarity between end-of-life performance of Fund 3 and Fund 4 of a given fund manager? But we wanted to understand whether at the moment Fund 4 was raised historically, was the intermediate performance on Fund 3 observable until that point of time a good indicator for future success? Very interestingly, at that point in time then, performance is not yet reliable. Performance is too noisy and it's generally not a good indicator, not a good recommendation for LPs to look at the performance that was generated until this point of time. Simply speaking, private equity for performance persistence breaks down if you only can base your judgment on the intermediate performance snapshot available to LPs at the time of fundraising, and it is not a practical investment strategy to invest based on performance persistence in private equity. Importantly, it even can turn the other way. Systematically, the very best performing funds presented to investors are sometimes among those which will be particularly unsuccessful later on in the next fund generation, and this often has to do with the fact that those who appear most attractive are those who are and have historically been able to increase their fund size particularly drastically, which then often comes down and hurts performance.
So what were you able to conclude from this particular study, and are there any recommendations that can be made based on those findings?
The first important recommendation is, of course, the warning I articulated before: do not just rely on past performance persistence. Interestingly, however, if you dig deeper and you look at drivers of return, you don't look just at IRR, for instance, but you look at alpha as the outperformance above the stock market. You look at sources of value and ask the question, how systematically have fund managers been able to generate value based on top-line growth or margin enhancement or active expansion of the multiples rather than just trading the markets. On all those factors, we absolutely do find signs of performance persistence based on a specific performance driver. So the big recommendation for LPs is don't just look at IRR, dig deeper, identify sources and distinct elements of value, those will be more likely to persist. And indeed, that's what many of the more sophisticated limited partners are doing today.